All right. Good evening, everybody. Welcome to the show. Tonight we have a investment education session on strategy to buy on dips using chart analysis. Before I start, once again, can you please check whether the sound is loud and clear and also the video is okay? So just comment yes on the comment section so that I know that you are able to hear me well. Thank you. Hello, Tan Buning. Hello, Rebecca. Florence, Chok Ting, Arul Sadayan, He Min Pang, YF Ko. Good evening, guys. Hi, Jason. Hi, Sing Te. Hi, Chami Flower. Hi, Rebecca Ting. Thank you, He Min Pang. Thank you, Ming Ying Fong. So, yes, we are ready to go. All right. Okay, so today we have a session once again brought to you by Bursa Malaysia. It's a series to actually educate investors to be well-informed investors. So we have a series of webinars lined up for you guys based on fundamentals, based on products, based on technicals, and so on and so forth. So today we're going to also cover technical aspect of analyzing price movements, and the strategy or the topic today is how do you buy when the price starts to dip after an uptrend? Meaning that if you have missed the trend earlier, at the beginning of a trend is okay, because as the trend continues to develop, you are still able to ride the trend if you know what you are doing. Okay, and this requires a little bit of timing, right? You need to know where the price is, where the support resistance levels are, and then we make a decision based on your analysis on the charts. All right. Now, let me just share my screen first so we can start today's session. Yeah? And if you have any questions, just type me those questions in your comment section. Then I'll be able to answer them once I finish my presentation, which we're going to take about probably an hour or so. And then we're going to take a look at questions. All right. So in the meantime, when I'm presenting, if there are anything that you need clarification or have any questions, please do type it down, and then I will be able to answer your questions after the session. All right. Okay, for those who are still new with Bursa Academy, please do visit them at bursaacademy.bursamarketplace.com. It is a new platform where it provides an e-learning materials to again provide investors with continuous learning in investing. All right, so please do visit them at bursaacademy.bursamarketplace.com. All right, so we get started now. I'm not going to do an introduction here. You can download the slides later, and later I'll share with you how you can actually download the slides after the webinar. All right. But before we start, this is very important. Whatever that is being shared here today and being discussed here today are for informational and educational purposes. It is not intended as any form of investment advice. All right. So if you need to consult an investment advice, please do approach a licensed and professional investment advisor. All right. So this is basically purely educational. All right. So right now we're basically going to discuss how you can identify a pullback and when is the best time to actually get in, so that you are the objective is basically to buy or enter at low risk as possible. All right, so that you are able to profit from a trade and minimize losses if there are any opportunities. All right, and it's always difficult to buy when prices are falling, and it's always easy to to buy when prices are going up. So I'll give you example, and I think if you have attended one of the webinars that I did, I think about the earlier webinars, you should you should actually learn why most of the traders and investors actually buy at higher price instead of buying them at lower prices, because the objective is quite simple, right? It's basically buy low and sell high, but it's always easier said than done, right? So especially if you do not have a technique or a strategy to do so. So this is what we want to achieve today, and we're going to use one of the techniques, right? There are actually many other techniques that you can use to identify opportunities when the price start to dip, and this is one of them, and this is one of my favorite as well, right? So right now, if you look at most of the price trends on most of the counters, they are basically going up higher and higher, right? We have higher highs, we have higher lows that defines as an uptrend. And of course, when the highs are getting lower and the lows are getting lower, then we have a downtrend. And like I said, most of the counters are now actually moving into higher highs and higher lows. But there are still a lot of counters which are still going into a downtrend, right? Because if we only look at the index as a benchmark for our market, then we are only looking at 30 counters, right? Because the index is only made up of or consists of 30 stocks. So we need to also look at the rest. And I said, I think right now it's about 50-50, right? 50% are in an uptrend, 50% are in a downtrend. Okay, so what we want to do is we want to focus on stocks that move into an uptrend, right? There are reasons why stocks go into an uptrend. There are reasons why stocks go into a downtrend. Okay, so we need to look at if the market is going up, right? If the index is going up, generally the market sentiment is bullish, then you should be focusing on prices that are going up in an uptrend. Okay, it doesn't mean that you have to buy when the prices are very high, right? Because you're thinking that, yes, I want to buy prices that go in an uptrend. Does it mean that I have to buy when the prices are high, right? So we will basically look at how you can identify opportunities in an uptrend itself. So first of all, we want to identify uptrend. An uptrend by definition means that the prices are getting higher. All right, so that's a rule. So where are the opportunities, right? If we buy when prices are going up and continue to go higher, this is when our risk will be at the highest. All right. We want to buy when the price starts to pull back. Now, why I mentioned this is this, right? Most of the investors normally, or traders who do not have a plan or do not have a strategy, or even sometimes those who have a plan or strategy, still end up buying at those high levels, right? These high levels, this peak here, simply because it is emotions. All right. There is this FOMO, FOMO, which is a fear of missing out, especially when prices are going higher, right? Everybody is buying, your friends are buying, you ask anybody, they're buying the stocks, but you are not in yet, right? And every day you look at the price, they're going higher and higher and higher and higher. And we'll be thinking to ourselves, now, if I don't go in now, I may miss the opportunity, right? So let's just give you a little bit of example. Now, let's say you buy over here, right? Let's say you buy over here. Now, let's say you buy at the peak. Okay, unfortunately, most of the traders buy at the peak. Now, how do you know whether there are a lot of traders and investors buy at the peak? Is that if you look at the charts, maybe later I'll show you some examples. You look at the charts, you'll see that volume tend to be the highest, okay, when the market peaks or when the price is at the top. Okay, that means there are a lot of buyers coming in. And then also, of course, when the prices go higher, it attracts sellers, right? It became a resistance level, it attracts more sellers, and the price have to pull back. So imagine if you buy at this level, right? Imagine by this level, and the price comes down, you get panicked. You say, "Oh, what to do now, right? I buy now so high, but it's coming down. It's okay. The trend is still going up. I may still hold. I'm still able to hold. And then the price starts to come down some more. Let's say it's already come down 10% from the price that you bought. Now you start to be a little bit panicky, thinking that should I hold or not, right? Or should I sell? Okay. And then while we were asking this question, the price keep on falling some more. Okay, it's like the market is trying to go against you, right? You're going against the tide. And the price start to come down. And now let's say it comes down to 20%, right? And you'll be thinking, you know what? I think if I keep on holding this longer, I'm going to lose even more money, right? I should have sold at 10%. I did not sell at 10%. I should have sold at 20% when it came down. It did not. And now it's down to, let's say, 30%. All right. And I'm thinking to myself, if I'm going to hold this longer, I'm going to lose more money. So what do I do now? I sell, right? So we'll be selling at this part here. And most of the time, you do not just, we just do not know what actually hit us, right? When the moment we sell, the price starts to rebound and go up again. Okay, now, do you have that kind of feeling before? Or have you experienced this before, right? So if you have experienced this before, just say yes. I've just click yes. That means that you have been trading. In fact, I think most of the traders have gone through this experience before, right? Buying, the price comes down, and when we sell, the price goes up. Okay, so at the end of the day, we do not want to end up buying at this high, right? Now, okay, even if let's say you buy at this high and the price came down and you still hold, okay? Now, what has going to happen is the price have to go up back again. You have to go up and rally to the previous high. That is when you only just break even, okay? If you buy at this price, right? Only if it goes higher than the price that you bought before, then you are in profits. Okay, compared to the one who bought, let's say here, right? If you buy here, if the price comes down a little bit more, you will not be so afraid, because you're already buying near the low. If it comes down another 10%, at least you compare yourself, this guy from this guy, you are in a bigger advantage, right? Because if the price come down another 10%, those guys who bought at the top here is now down 40%, while you are only down 10%. All right, and if let's say the price starts to rebound, another 30% upwards, okay, those who bought here has only started to recover or break even. Okay, but here, those who bought here can already make a 30% profits. Okay, so find opportunities when the price pulls back after an uptrend would be the low risk or the ideal trading opportunity, right? But the question is this: when do I buy, or what price level do I buy when the price comes down? All right. So a dip, okay, is also called a pullback. Okay, it's part of a correction of a trend. Okay, price do not go all the way up straight all the way, right? It will go up at a certain level, and when the price comes to a certain level, at a high level, when price go high, it will attract sellers. Right, so the sellers will start to come in, and the price will not be able to go higher, and then price will start to pull back, right? And those who wanted to sell have already sold finish, let's say it's completed, then the price will be able to climb higher again. Okay, that means that correction is over, okay, and a new trend is formed. And after every new trend is formed, the price will go up higher and higher and higher. It tends to pull back for another correction again. All right. So the question right now is, which level should the price pull back to before it continues its bullish trend? All right, so that's what basically we want to know. Okay, yeah, when I started trading as well, one of the things you will try to figure out is that why is it that the market seems to know what I'm going to do, right? It's like when I buy, it takes the money away from me, and when I don't buy, I don't go in, that's when they want to give me money, right? It's like market is designed to take the money from you, right? But you know what? It's not because the market wants to take away the money from you. It's just basically that we are buying and selling at the wrong time and the wrong price. All right. And that's because we are not well informed. So that's the reason why we have this kind of investment education series, right? To basically make you a more well informed trader investor. Now, I'm just gonna give you a bit of concepts about pullbacks and also a retracement. All right, it can be called a retracement. That means the price has pulled back and retraced certain level of a particular trend. For example, let's say the trend starts from here at the bottom and it ends here. Okay, so this is one trend. Okay, this is one trend. So if the price, let's say, pulls back to this level, that means he has pulled back or retraced 50% or half of this trend, of this uptrend that we see here. All right. If the price go back all the way down here, that means the price has fully retraced from this trend, or 100% retracement. So that's what retracement is all about. All right. So there can be many different levels, right? The question is, which level would the price pull back to where it was going to find buyers, is going to, it's going to attract a lot of buyers and find a support, and then start to rebound and continue its uptrend. Okay. So we're going to talk about Fibonacci. So I'm just going to explain to you. You probably heard about Fibonacci retracement. You probably heard about Gann analysis and so on and so forth, right? Or even Elliott wave, because Elliott wave use a lot of Fibonacci's, right? So, but what are Fibonacci numbers? So I'm just going to basically give you a a short lesson on Fibonacci. So basically is the number Fibonacci is actually a series of numbers, okay, or a number sequence. Okay, so we're going to talk about that, right? So this guy Leonardo Bonacci, or Leonardo Fibonacci, or Leonardo di Pizza, because he's from Pizza, Italy, right? He's an Italian mathematician from 1170 to 1250. So he spent a lot of his time, and most of his time, finding mathematics, or discovering mathematics and statistics in Arab, okay, in the Arab nation. I'm not sure which Arab nation he went to, but I just know that he actually went there. So he has this book called the Book of Calculation, okay, or Liber Abaki, on 1202. Okay, and there are many discoveries that he made for mathematics. Okay, but there are two major discoveries that he made, which has significant role in today's in today's era, right? Or even in terms of technology and also mathematics. So one of the major discoveries that he made was the use of Arabic numerals. Now, if you still remember during the Roman times how they write numbers, right? You have the one which is I, and then I, and then IV, and so on and so forth, right? So sometimes you want to write a number, you actually have to think so hard, right, to actually write a number. Now imagine if you want to write a number based on the Roman numerals, right? 568,925.6. Imagine if you write it down in that Roman numerals. It's going to be really tough, right? So this guy Leonardo actually found an easier way. He saw the way Arabs write numbers, and he said, you know what, this is probably the much easier way to write numbers. Okay. So if you look at today number that we write 1, 2, 3, 4, 5, and 6, it actually comes from the way the Arab write numbers, right? So that's where it came from. Okay, so that's what he discovered, and he brought back to Europe and spread this. Instead of using that Roman numbers, it's better to use the Arabic, the way the Arabs write numbers. Okay, now the second major discovery is the Fibonacci sequence. Okay, what are those sequences? Because there are a lot of theories, on how this guy actually came into this number sequence. Some of them say that it came from nature itself. He was looking at the fields, and then suddenly he saw a group of rabbits, and he found out that the rabbits came in groups and in certain patterns, okay, based on the numbers. Okay, so, and some of them say, no, you know what, the guy just dreamed, or some of them just say it was just pure luck. Okay, so depending on which theory you want to recognize lah. So Fibonacci is very significant today. It's like a divine revelation in numbers, right? It's considered one of the most important mathematical representation of natural phenomena, which later I'm going to just share with you. It can be found in nature. It can be found in geometry, right? Which means that engineering is it also plays a very important role in engineering and also music. All right. So this is basically the Fibonacci number series. Okay, so all number of course start with 0. The number series can be, if it's an even number, it's 2, 4, 6, 8, 9, 10, right? 2, 4, 6, 8, 10. Okay, now the Fibonacci number also start from 0. So you know what? And then the next number is 1. So this guy Leonardo maybe got nothing to do, and he'll be thinking like, what happens if I add the number now and add the current number and the previous number? What number do I get? So you take 1 plus 0, he get 1, right? So the next number is 1. So that's why it's 0, 1, and then 1. And then say, what's the next number? Oh, 1 plus 1, right? 1 plus 1, you get 2. Okay, and then you take, what's the next number? Oh, 3 plus 2 is 5. 5 plus 3 is 8. 8 plus 3 is 13, and so on and so forth, right? Like, for example, here, you'll know what's the next number, isn't it? Okay, it's 89 plus 144. Okay, and the number just goes on. So it doesn't just stop there, right? Because if you just look at this number alone, you just see like, this is pretty much random, isn't it? Okay, but the most important is actually this ratio. Okay, you take the current number, any Fibonacci number, divide by the previous Fibonacci number, you get this ratio of 1.618. Okay, and you take any number and divide by the next number, okay, you get this ratio 0.618. Yeah, when the number is bigger, the ratio, the ratio, or that calculation, okay, the answer is very close to 1.618. If you take a small number, like for example, 5 divided by 3, you don't get 1.618 lah, right? But as the number gets bigger, it gets 1.618 and 0.618. Okay, so any number. So what's so significant about this? All right, so when we look at this percentage, okay, of course, whenever there's a discovery, universities and professors, and scientists will start to do research, right? In-depth research on the consequences or the significance of these ratios and numbers. Okay, so one of the first discovery was the growth of this shell or the spiral shells. All right. So he did a calculation that you see that the growth or the way how the shell growth is actually based on a Fibonacci sequence. Right. For example, let's say this is a very small shell. This is two square millimeter, right? That area, and then when it grows to 3 square millimeter, 5, 8, and 13. So is this ratio? It's 1.618. It's continuing to grow 1.618. All right. So that's one. And then if you look also, of course, even in our own body will show Fibonacci numbers. Okay, you can go back and see whether you are whether you have Fibonacci number. For example, you have two hands, right? And two hands, and each hand have 5 fingers. Okay, why not 6? Why not 7? But it has to be 5, right? Which is a Fibonacci number. And then every finger is divided into 3 parts, which is also a Fibonacci number. Why not 4, right? And that 3 parts is divided by 2 knuckles. Okay, and if you go and read further, you just go to Google, you just type Fibonacci, you'll see a lot of examples, and of course then you will jump into a rabbit hole as well. Okay, because there'll be a lot of conspiracy theories behind Fibonacci as well. So one of my favorite is always this, right? So if you take if you measure, all right, the length between the top of your head to your belly button, the belly button, right? You take that measurement, you multiply 1.618, you should get your height. All right, you should get your height. All right. But you know what? It may not be 1.618, maybe near there, lah, right? So I do not know. You can go and measure yourself, because now as we age older, maybe the belly button also goes lower. So the measurement is totally out, lah, right? But yes, it exists in most of the whatever that's being touched by human or in nature itself, right? So you see, in order to have a perfect body, all of your body, the parts of your body, like your leg length, your arm length, and so on and so forth, has to be proportionate to a Fibonacci. Then you're basically a beautiful person. All right. And then how do you see a person beautiful? If the person's eyes, nose, ears, and the position of all these parts are based on a Fibonacci sequence, then you will consider beautiful. But if you go and dig deeper, they actually try to construct, right, a face that has a Fibonacci real pure Fibonacci ratios, right? The position and all that. They found out that the person looked like a Mongolian, like that the Genghis Khan. Okay, so if you think Genghis Khan is handsome, maybe he was lah, right? I don't know. Okay, so even the Mona Lisa painting, you see that the painting itself has a Fibonacci proportion. Okay, it exists in nature. For example, most of the, in fact, all of the petals in flowers are Fibonacci numbers. Okay, 3, like this, the white trillium flower over there has 3 petals. The St. John's wort there have 5 petals, and so on and so forth. They are all based on Fibonacci. Why not? Like for example, the St. John's wort petals. Why not 6? Why not 7? But why 5? Right? So the study goes on. Okay, and this is one of the significant study for engineering. Okay, this is Pantheon. Right, it's one of the oldest building. I think this is like 2000 BC. So that means it's already 4,000 over years old, and this building still stands until today. And then discovered that even the building is built using the Fibonacci ratio measurements, right? The length, the roof, and the pillars themselves. Okay, if you look, they are all based on Fibonacci ratios. So it's quite interesting, right? So and because of that, this building is able to stand even after 4,000 over years. All right. So this why this ratio has become significant even in engineering itself. But what has it got to do with the charts, right? What has it got to do with technical analysis? What has it got to do with trading? Okay. Um, Now, of course, when we look at Fibonacci itself, we'll be thinking, yeah, does it work, right? But because Fibonacci sequence is in nature itself, then it should also be reflected in the markets, because the markets are basically not driven by robots, it's driven by humans. Okay, and humans have emotions, and therefore it should show some characteristics of a Fibonacci sequence. Okay. um, so these are the important ratios. Remember, 1.618 is one of the important ratio, and then you have 0.618. Okay, and the opposite of 0.618 is 382. That means you take 1 minus 618, you get 382. Okay, so in Fibonacci, there are two major tools that are being used. One is called a Fibonacci retracement, which we're going to talk about today, because retracement is about dips, right? Is pulling back. Okay, so we're going to talk about retracement, and the other tool that is also being used is extension or expansion. Okay, and normally expansion is used to do forecast, okay, or price forecast. And of course, expansion, or of course, retracement is also used to forecast where the price is going to retrace, right? But both of them are used in for different purposes. Okay, expansion is used to tell us how far the trend can go some more, right? How high the trend can go some more. Whereas retracement tells me that how low should the price pull back in that uptrend. Okay, so two different ways of using it. So Fibonacci retracement use 0.618 and 0.382. Okay, and of course there's another one in the middle, which is 0.5, which is also a Fibonacci because it's divided by 2, right? And then 1.618 is normally used for expansion, right, or extension, or Fibonacci extension. So in this example, in today's lesson, we're gonna talk about dips. So we're gonna talk about retracement. So we'll be using these three major retracement levels: 38.2, 50, and 61.8. Okay, in percentage. Now, if you're going to study further on Fibonacci, these are the two books that you can actually go and look for. All right. On the left is one of my earliest mentor. Okay, his name is Joe Di Napoli. Okay, he is dubbed as the godfather of Fibonacci for those technical analysis circle. Right. And he is one of the most very straightforward, okay, open-minded trader, and also a trainer that I've known, right? And this guy wrote one of the most expensive technical analysis book probably in the world, right? And his book, because it's not being published publicly, he self-published this. You can only get it from him. I'm not sure whether it's being published now in the bookstore. You can try and find out, right? But during that time, about 15 years, 20, nearly 20 years ago, right? His book was selling about $700. It's like basically attending a course, right? $700. Yeah. So yeah, Joe Di Napoli. So he basically talks about he called the book Trading with Di Napoli Levels, because he only used certain percentages, and the way he used Fibonacci retracement levels are a little bit different. All right. So that's why it's called the Di Napoli levels. But basically, the fundamentals is from Fibonacci. Now, the one on the right, we also get to know him personally. His name is Alan Oliver, and he's basically an Australian, right? Now, the Joe Di Napoli is actually an American, but he resides in Thailand, right? And he trades there in Thailand. So this guy, Alan Oliver, also a trader, is based in Melbourne, Australia, right? And he has one of the most interesting books that I find. Okay, it's called Trading with the Gods. Now, how can you beat this book? I mean, if you want to have a title again for trading, who can beat this title, right? Trading with the Gods. Okay, so I find it very interesting. Now, so basically, the book is also about Fibonacci, and not just Fibonacci. It also talks about other ratios, which are um, considered as divine numbers. Like the number, the pi, right? 1.4111, whatever it is, the pi number is also a divine number, right? Is a given number, because without that number, we will not be able to calculate a lot of things. Okay, same thing with Fibonacci as well. So that's why he uses all this. I mean, these are the two guys that study retracement, Fibonacci, especially Fibonacci, and come up with ways to use it. All right. So if you want to explore further, you can get these two books. I think Trading with the Gods, you can get it. I'm not sure about the Napoli levels. You can try, or you can just go and search in Google and find out where you can get it. All right. So a retracement level is where the price retraces from a bull or a bear trend. Like in this case, let's take a look at a bull trend. So I already shown you earlier, when the price pulls back, right? It can be at any level. It can be half of it. It can be, if it comes down all the way back down here, that means it has fully retraced or retraced 100%, right? So let's say the price, trend, the beginning of the price trend is this. Okay, the beginning of an uptrend is here. And the price keep on getting higher and higher and higher and higher and higher and higher. And if let's say I'm using a Fibonacci retracement tool, or let's say my strategy is to buy on pullback, that means I will not be buying when the price are going higher, right? Your strategy is to wait for the price to pull back. So when the price starts to pull back, then we have a potential ending of a trend, which is up here. Okay, so when we draw a Fibonacci retracement tool, we have to identify 2 points. Okay, number one is the beginning of an uptrend, and number two is the possible ending of an uptrend. Okay, often it's easier to identify the beginning of an uptrend. It's quite difficult to find the ending or the possible. That's why I say, that's why I call it possible ending, right? Because it may be high right now, and it may be pulled back for 1 or 2 days, but after 1 or 2 days later, the price goes higher. So that high is not the high anymore. There's a new high that's forming. All right. So when the price, let's say, continues to pull back, as long as it continues to go lower, then only you can see clearly that this is a possible ending of this particular trend. Okay. So once you have this, maybe later I'll show you how to plot it on the chart using investing.com, right? So that you give you an idea how I plot the Fibonacci retracement. Okay, but you need 2 points. You have to remember that. So you point at the first part here, and this will be the second part. And once you have identified them and you apply that tool, then you will get these retracement levels automatically plotted on the chart. Right. So you have the 38.2, you have 50, and you have 61.8. Okay, and there are also other minor retracement levels, right? There are also other minor retracement levels, like there's a 23.7 or something. I forgot that ratio as well, but it's just a small one. Okay, but the major retracement levels are 30.2, 50, and 61.8. Okay, the 61.8 and 30.2 is, in fact, is just opposite. All right, so if you label this wrongly, it's also okay, but because at the end of the day, you just want to find where the levels are. Okay, so if the price, that means if the price pulls back to this level here, that means it has retraced 38.2% from the bullish trend. All right, if it comes down here, that means the price have retraced 50%, and if it come down here, the price have retraced 61.8%. Okay, so this is a bull trend Fibonacci retracement level. Now, in a bear trend, is the same thing. When prices are going down lower and lower and lower and lower, and it starts to rebound. All right, so the opposite of pullback or dip is called a rebound. Okay, so if it rebounds, let's say, to this level, that means the price has retraced or rebounded 38.2% from this downtrend. All right, if it comes here, that means it has retraced 50%. If it come here, it means it has retraced 61.8% of the downtrend. Okay, hope you are following me so far. Okay, Fibonacci retracement tool is widely used together with Elliott wave. All right, Elliott wave is a market structure based indicator. Right, it's called an Elliott wave theory. It's not really an indicator because it's not as very straightforward like Fibonacci, or it's not as straightforward as the moving average or MACD. It's very clear cut, right? That you can see. But because Elliott wave are based on rules, all right, to identify that market structure, right, you need to follow a set of rules, then only your wave counts are correct. Now, the reason why people want to do Elliott wave theory or to count the waves is because they want to know what would be the next wave. All right, so that's the reason why they use Elliott wave, and it's not one is one subject which is not easy to master because you have to follow the rules and you have to do a analysis, right? So if let's say the stock began 20 years ago, you have to make sure that the rules, okay, would fit on the 20 years of data. All right, so if let's say you have calculated a wrong wave, okay, that means that you probably missed out one of the two rules. You have to basically do a calculation all over again since the beginning, which is 20 years ago. So it's really time consuming. All right. um, so although it's being used or widely used together with Elliott wave, it doesn't mean that you cannot use Fibonacci retracement tool as it is. Okay, of course, if you know a little bit of Elliott wave, just some structure, just some concepts, you will find using Fibonacci retracement more effective. All right. But like I said, even if you don't know about Elliott wave, it is okay. We can still use Fibonacci retracement. All right. So now, so that's Fibonacci retracement. It's a very simple concept. It's a very simple tool, right? But remember, the idea of using these tools are basically to find that support or resistance level. That means when the price pulls back, I want to know where is the support level. Okay. In our previous webinar, we talked about we use trend lines, right? So to identify where's the next possible support or resistance level. Okay, so Fibonacci retracement is no different than using a trend line, but the way it's being used is different. All right. So at the end of the day, we want to identify where is the real support or resistance levels. All right. Now, how do we apply a Fibonacci retracement tool? So first of all, you need to see whether what trend it is first, right? Whether it's an uptrend or a downtrend. So how do we know it's an uptrend? Of course, when the high is higher than the previous high, okay, it keeps on getting higher, we have an uptrend. And if the lows are getting higher as well, then we have an uptrend. Okay. And then the second part is to identify where is the possible beginning of the trend and also ending of a trend, right? So if I look at this chart here, for example, okay, I can start the trend down here, all right? Or I can also have the beginning of a trend down here. So question is, which one, right? Should I start on the bottom or should I start from the second one after the pullback, after the first pullback? Now you can use both if you want to, right? There is no wrong answer because in fact, we will normally use both because you will find what we call a confluence of Fibonacci retracement levels, which I'm going to explain later. All right. But for now, I just want to make the concept easy first, so for you guys to understand. So we're only going to take a look at the current trend. Okay, how do you define a trend, right? So now how do I know whether this is a new trend or whether this is a trend which has existed even for some time ago, right? So every trend has this, right? If we have prices going up, that trend is not over yet. As long as it continues to go up higher and higher and higher and higher, that trend is not over. That means it's still continuing. But when the price starts to pull back, all right, for a correction of that uptrend, okay, of course, if when the price pulls back and retrace 100%, that means go back to the bottom, that means you don't have trend lah, right? That means you don't expect the trend to go up or continue because there's no more trend. Okay, but if the price goes up, for example, let's say it has pulled back 50%, and after it pulls back 50% from the trend and it continue to go higher, so that then we have a trend that's developing. All right, so that movement, the early movement where it pulls back to 50%. So after the pullback of 50% and the price go higher, that means that first trend is completed. Okay. The second trend starts from the moment the price rebounds from that 50% retracement. Yeah, I hope you get this. Like for example, right? If you look at this trend here, this is the first trend that is going up higher and higher and higher. Then what happened? The price pulled back for a correction. Okay, so once the price has pulled back and finished its correction, that means this first trend here is over. Okay, or Elliott wave will call it the first wave. All right, and then this is wave two, a correction. Okay, and then the price will start to move into a new trend again. So this is a beginning of a new trend or a new wave. Okay, so you want to do a calculation, for example, to start off with, I will start to look at the trend beginning here, the new trend, not the old trend. The old trend is already over, right? But of course, the old trend can also be a current longer term or bigger trend. That's why you can also draw at the bottom if you want. Okay, but right now I'm just gonna look at the new trend. Okay, so this is the, let's say, the beginning of that new trend, and this is the possible ending of a trend. Remember, as if the price goes higher, then my X will also go higher, right? There's a new higher. As long as the price go higher, so it's going to go higher and higher and higher and higher. Because remember, the objective is not to buy when the price goes higher. Okay, your objective in this strategy is to buy when the price pulls back. Okay, so that means when the price has to pull back first, go down from X, then you want to buy. Okay, so let's say I plot here. Let's say this is the current high. Okay, and this is the bottom, right? The beginning of a trend. So now I started using the Fibonacci retracement indicator or tool. Okay, draw from here up to here, and once you establish that, you will get these three levels. Okay, all of these are automatically drawn. Okay, so 38.2, 50%, and 61.8%. So step number 3 is determining or trying to figure out which level will the price retrace to before it continues going in uptrend. All right, could it be 38.2, 50, or 61.8? All right, which one is a better one? So I still have A, B, or C. Okay, for example, this is a composite index, which I did an example a long time ago, right? Let's say the beginning of a trend here, okay, and this is the possible ending, and the price is pulling back, okay. And when I put a Fibonacci retracement tool, the 38.2% is where A is, 50% is B, 61.8% is C. So question is, which level would the price find support? A, B, or C? Okay. So this is where, again, when it comes to trading, it has to be objective, right? It has to be straightforward. It has to be clear, because if you have subjectivity, then your trading plan will not work. Okay, because you said maybe A, maybe B, maybe no. There's no maybe A, maybe B, or maybe C. It could be one. All right. But you have to remember, this is just a tool, right? When we come up with a trading plan, it can be different. Okay? For example, and I do not want to figure out A, B, or C. Let's say, right? I do not want to figure out where they are. But what I can do is that the price has a very high chance that it's going to rebound to either one of these levels, right? A, B, or C. I just do not know which one. Okay. So what I can do is I have two options. I can guess which one is it. Okay. So when, let's say, if I want to buy at A, so when the price comes down to A here, for example, I'm gonna buy. I'm gonna just buy everything, right? Buy this particular counter. Or if I say I'm gonna wait at B, then I'm gonna buy at B. Okay. But if having this option is, you have pros and cons, right? If let's say you buy at A, okay, if the price rebounds from A and go up, fantastic. That means you are able to identify the correct support level. But what happens if you buy at A and the price continue to fall? Then you think, oh, it's not there, right? And the price continue to fall. Okay. So that's the problem, right? Because the price can still go to B or C. Okay. If I select B, now I also have pros and cons, right? The pros is the price comes down to 50%, fantastic. It rebounds, it goes up, nice, right? But there is still a chance for the price to come down to C. Okay. Or the price do not even come down to B the moment it goes to A and it rebounds and go higher. Okay. What if I select only C? So if it comes down to C, nice. Price rebounds from C and it continues the uptrend. But what happens if it does not come down to C? The moment it goes to A, it continues to climb. The moment it goes to B, it continues to climb. Then you missed out, right? So which one, right? Okay. Now, so in trading, like I say, you have to be flexible. You have to be, this is all, again, if you are able to build a trading plan, it's mostly based on experience. Okay. For example, let's say I do not want to guess A, B, or C. Why not? If I'm going to buy this particular counter, for example, I reallocate the position size. Let's say 10,000 shares, right? I'm going to buy 10,000 shares based on this. but I do not want to guess and buy 10,000 shares at A, B, or C. What if I'm going to buy, let's say, 30% or 33% or 3,300 shares when it comes down to A? So at least when the price rebounds from A, I'm still able to hold the 3,300 shares. All right. What happens if it comes down to B? That means I buy at 3,003 at A and I buy another 3,003 at B. So I have 6,600. Okay. So even if the price rebounds from B, now at least I am in position with 6,600 and my average price has come down a little bit. What happens if I buy at C, A, B, and C? So if the price comes down to C, that means I buy 3,003 here at A, 3,003 at B, another 3,003 at C. Okay, and when it rebounds, that means my whole 10,000 right now is in that trend. Okay, that's one option as well. Okay, so of course, if let's say you want to find one, then there are ways to find that one particular level. Let's say you want to find one. Okay, so now you have to look at other clues from the market. So same thing here, right? We have A, B, or C. Now you can also use support and resistance lines to identify and see whether that particular level was it previously a support or resistance. All right. Now, for example, let's take a look at A. Okay, A over here. You look at this line historically, it wasn't any support or resistance levels. All right, so there's no clue from support resistance levels. Now, if you take a look at B, this line over here, it was previously a resistance level once, and you go back further here, it also provides a resistance twice. So B, the 50% Fibonacci retracement level, is in confluence with this resistance line. Okay, so that's what I meant by confluence. Confluence is when you have, or a cluster is when you have 2 or 3 indicators at the same level. All right. Now you look at C. C is also a line that goes through the price and does not show any support or resistance levels. So if you ask me if I have to choose one, then I will choose B, right? Because B will be the better option because B has 2 indicators showing at that level. Okay, one is the Fibonacci retracement and the other one is a previous resistance level. All right. So what happened was this, right? So the price actually came down and it went exactly on 50% retracement before it rebounded upwards and continued its uptrend again. Okay. Now you can do this. You can do this example after example. On technical on charts, right? Just go and do. You'll be amazed on how market reacts on these Fibonacci retracement levels. Yeah, it's either 38.2, 50, or 61.8. Okay. Now let's take a look at a stock example. That was an index, right? So let's say this is an uptrend and this is a possible beginning of an uptrend and this is a possible ending and the price is pulling back. So I will not be buying at when the prices are high like this, right? Now again, there will be a lot of people who be buying at these highs. Why? Because the volume, although I did not show here, volume normally will be very high here. Now imagine if you bought at that high here and the price starts to come down like this. Okay, you feel sad. Why? Because now instead of the price going up when I'm buying, it comes down. Okay, but for those who are waiting for a deep opportunity, will wait, right? And if let's say I'm using a Fibonacci tool, just draw the Fibonacci tool, and then you have the 38.2, 50, and 61.8. So same thing, right? We have A, B, or C. Which one? Okay. Like I say, you can apply that strategy where you buy A, B, and C by different proportions of your position size. Okay, or let's say if you want to select only one, then I will have to look at whether there are any confluence. Okay, for example, A over here, A, if you look at historically as well, there is no support or resistance at A at this price. Okay, now when we go to B, B was a previous resistance level here, and it was also another resistance here. So same thing like when we see the composite index, it was resistance level twice, right? C was also a resistance level. Can you see this, right? C was also previous resistance. So it can be B or C, right? B or C, because both of them show there is previously a support or resistance. Now remember, you can also draw trend lines, right? For example, we have an uptrend over here. You can actually draw a trend line that goes up like this. Okay. So I can also use that uptrend line as a support or resistance level too, right? So I have a third option. I have a third opinion, right? The second opinion was here B. Okay, it can also be C, right? Because it was also a resistance level. Okay, but why I would choose B is because of this, right? If you look at this trend line over here, now if you look at the current price right here, and if you look where the uptrend line is, this is the uptrend line, right? This one is going up. That's uptrend line. If you look at the uptrend line it is down here, right? That means you'll be thinking, you know what, C is the better one, right? Because C has the horizontal line resistance and it's also the uptrend line support level. So we have two confluence here. And with the Fibonacci retracement, it has three indicators showing that there is support here. Okay, but I cannot put the trend line support level up here because you don't expect the price to drop one day and go down straight like that, boom, and come down here. All right, does it just come down straight? Okay. The best you can do is normally the price will just fall and go sideways. And remember, this is the time and price chart, right? So the price will start, the price will continue to move forward. Okay, so if you give it a little bit more buffer to the front, you'll see that this price, of course, the trend line, because it's going up and over time it keeps on getting higher, it will eventually confluence or eventually meet B. Right? But you need to give it enough room for it to go forward because the price, it goes forward to the right. Okay, I cannot use the current existing one at the bottom because that's the bottom, that's current, and you don't expect the price to come down. Okay, so so B will probably be the better alternative. Why? Because it, number one, is a 50% Fibonacci retracement level. Number two, it was a previous resistance level, which is a horizontal line. Number three, it is also it could also possibly be the support level of this rising uptrend line. All right. So let's see what happens here. So the price actually came down here exactly on 50% again, and one particular day it rebounded. So it tests that particular day itself, it tests that level, and then immediately it rebounded. Okay, and then after that, the first rebound wasn't successful. It came down back again, and the second time it came back this level, and you can see the confluence here, right? It came back to this level once again, still being supported twice. And this time, this is where you can actually get, if you let's say did not manage to get in the first one, you can still get in the second part here when the price pulls back again, right? Because after second round, second time testing, then the price really start to rebound and go up. Now imagine, right, like I said again, if you buy here, your risk will be higher because after so many months, after 1 year, the price still haven't come back to this level. So you still haven't break even yet. But if you buy near the support level, okay, now this uptrend line here, and also the 50% Fibonacci retracement level, and also the previous resistance level. So we have three confluence of indicators over here. Okay, if you buy at the low here, the price rebounds, you make profit. Okay, those who bought here will not be able to make profits. And the good thing is, you know what? If let's say you buy here and the price comes down and make a new low, you can immediately cut your losses because you expect that to be the lowest where you buy at the retracement level, right? The moment it breaks below that retracement level, you can exit and your losses will be small as compared to those who bought again at the top. All right. Now I'm going to show you one more recent example. I think for those you're familiar with this chart, you know what chart is this, right? This is a one very strong movement chart. This is May. It's a 1 month. The price moved from 7 ringgit to 16 ringgit, right? So that's about nearly about 140% gain in 1 month. Okay. So as the price is going up, I'll not be buying because if I'm going to buy at a high, then my risk will be high again. Okay, but you know what? You'll be continue to be tempted, right? Because you think that the price has gone up from 7 ringgit to 10 ringgit, and we think it's high lah, right? It's too high already. 7 ringgit to 10 ringgit already move up more than 40%. In just 1 week, it moved 40%. So can it be sustained? So we wait for a pullback, right? And think, I'll wait lah. If the price comes back down to 9 ringgit, maybe I'll buy. Now it's 10 ringgit, too high. Okay, but the price did not come down to 9 ringgit and it continues to go up. 11, 12, 13, every day go up 1 ringgit. And every day is tempting you to buy. Because you know what? You did not buy at 10 ringgit and now it's 11 ringgit. And you tell yourself, oh, you should have bought at 10 ringgit, right? And you still didn't buy at 11. And then the next day it goes up to 12 ringgit. And you says, yeah, I should have bought at 11, or even 10 ringgit. But because the price is high, you'll be thinking, but now it's a high price, right? I cannot buy lah. Okay, and then they don't buy at 12 ringgit, and the price go up 13 ringgit. And this happened on a daily basis, right? It's like every day you don't buy, you miss out 1 ringgit. Okay, and eventually we all succumb to this this pressure, right? This temptation to actually buy. Like for example, you see, today don't go up 1 ringgit, instead of 1 ringgit, today it went up 3 ringgit. I said, oh, you know what? I should have gone in. Now it gone up 3 ringgit is very strong, right? Maybe it's a time, maybe right now is the time to get in. It will always tempt you, because trading is really emotional, right? Okay. But like I said, if I'm waiting for a pullback, I will not be buying at a price, I'll just have to wait for the price to pull back. Okay. If it doesn't pull back, that means I will not be buying the share. But don't worry, because you're not looking at only one share. There are other shares where you can find potential as well. Yeah. Don't think that the whole market is only based on 1 or 2 shares. Okay. There are other opportunities. But the most important thing is not trying to identify that particular counter, is how you apply your trading plan. Whether you have the discipline to follow your trading plan. That's most important. Because if you have the discipline to follow the trading plan, then you should be able to identify a lot more trading opportunities. All right. So going back to here, same thing. So I start from here up to here. Okay, so we have A, B, or C. So question again, which one, right? A, B, or C. Okay. Or like I said earlier, you can buy 30% here, 30% here, 30% here. A 30%, B 30%, C 30%. Okay. And if I'm going to use this, it makes trading much easier. You know why? Because I know what price I'm going to buy. Okay, for example, A is at about 12 ringgit and 70 cents. B is around 11 ringgit and 60 cents. C is 10 ringgit and 5. All right. So when the market opens the next morning, I can immediately put a buy or limit buy here at 12.70. Let's say 30% of that position size. And then another 30% I'm going to buy at 11.60. And another 30% I'm going to buy at 10.50. Okay. So I just put a buy there. If the price goes down to that level, fantastic. Okay. That means I'm able to catch a support level. And if it rebounds, it's even better. All right. If I only to decide one, for example, let's say between A, B, or C, I have to decide one. So which one would be the better one, right? So again, you go back and see whether there are any confluence again, right? So you look at A. A was, this is a straight line, so you don't see any confluence here. You look at B. B was actually a support level, but for just one particular day, it was a support level, right? For this particular candle over here, you can see that the low was at B. Okay. But here will be more better because at C, you can see the price congest around this level for 4 days, right? It just moved that sideways. So there is a significant, okay, at C. Okay, that's when price starts to move sideways a little bit. Okay, there is some certain form of resistance over there. So 61.8 will probably be the better choice. So if I only have one option, then you know what? I'll just put a buy at 10 ringgit and 50 cents, for example. Okay. So now if you ask me, I prefer to have, I don't like to try to figure out which one. I will have normally 2 levels. Okay. You can either buy A and B, or A and C, or B and C. Okay. But A normally I will have to include because sometimes the price just come down to A and then rebound. Because if I do not buy at A, then I may miss some opportunities. So it's either A, B, or A, C. All right. So you buy A, C, that means your average price is around B lah. Okay. So let's see what happens after this, right? Okay, so C will be the better alternative. So if I'm an analyst where I have to come out with one, then I will come up with C. Okay. So now probably if you look at this chart, you know what counter is this, right? So now look at this, right? The price actually came down. That one particular day itself went all the way down to 1050, and immediately after that, it rebounded back up again, right? From 14 ringgit and 70 cents, went all the way down to 1050, and then go back to 1470. So imagine if you have bought this at 1050, right? At this retracement level. Okay, on that one particular day itself, the price goes up almost 50%. Just one particular day. Okay, that's still, if you want to be more certain, if you bought at A, 30% at A, 30% at B, 30% at C, you get all these, and the price rebound, also you still make money. You still make about 30% because your average price will probably be around here, that B here at around 1170. The price get up back to 14 ringgit and 70 cents. That's just three over ringgit, right? So it's almost 40%. Okay, so the price rebounded, and not only that, look at this, the price continued to climb higher. Okay, not only 40-50%, you can make probably 100% if you just buy here and then sell up here. Okay, then the price pull back again. Of course, this is part of this correction over here. The correction is not over yet, right? Until the price move into a new uptrend. So once this correction is over, the price moves into an uptrend again. Okay, so I do the same application, right? I can start the trend, the beginning of a trend down here up to current level. You can do that. Okay, later I'm going to share with you, right? Because I'll tell you what counter this is, right? From here to here, and then of course another one would be from here or from this bottom here, because this is the lowest in this correction. This is the lowest, so I can start from here all the way up here as well. All right. So let's say I'm going to put a Fibonacci retracement from here to here. Okay, so I get A 38.2%, B, or again C. Okay, so I look for, let's say I'm going to look at A. A did not show any support or resistance previously, so A is out of the questions. B was previously a resistance level, so B could be a possible candidate, right? C at the bottom does not show any support or resistance level. Okay, so the only option right now is B, correct? And then if I draw a trend line like this, that it connects these two bottom here, and in fact 1, 2, 3 bottoms over here, right? And bring this forward, it also goes to B. Okay, but remember, this uptrend line will not provide the support currently, because this is currently, right, this is the current price. Remember, you have to give it enough room forward to move a little bit. Right, so if you give it a little bit more room to move forward, this uptrend line will probably go to A, or 38.2%. Okay, so now I have a dilemma again, right? It can be A, it can be B, because A is supported by that uptrend line. 50% of B is supported by this previous resistance level. So each of them has its own weight. So the question is which one, right? C does not show anything. So again, if you have a doubt, if you're confused, then split your position size again, right? If you have only two options, for example, then you split the first half here, buy at 38.2%, which is about 1980, and then split another 50% here and buy at 18 ringgit. Okay, let's see what happens after this, right? Now the price actually pulled back, right? Continue to go down, and what happened here? It rebounded from 38.2% and go higher. If you only buy at 50%, then you will miss this another opportunity. Right? If you put at 61.8%, definitely you'll be missed out totally, right? It doesn't even come down here because the price only went to exactly at 38.2% and rebound to the current price up here. Okay, so that's basically so this is top glove right? For those who are trying to look out for example, because I'm going to plot again. I'm going to show you what happens if you draw a Fibonacci retracement from this bottom down here. Okay. Okay, so you guys already know the answer, right? So early I'll say top glove already. Okay, guys, so if you have any questions, you can ask me right now. Okay, I'll take a look at your question. So what I'm going to do is I'm going to just basically switch my screen into the investing.com so that I can show you the how you find confluence of Fibonacci retracements and how you draw Fibonacci in the first place. All right. So let me just stop the screen for a while and share my another screen. Okay, so now you should be able to see my chart over here. Now, so this is investing.com, right? And this is the KLCI chart. Okay. So what I'm going to basically share with you, see whether you can see, whether when the index pullback, does it go to any Fibonacci or not? All right. So again, identify trend, right? So this whole thing here can be one trend, right? Since the beginning in March up to the current high at 1,616, right? Or 1,617 points. Okay, that could be one trend, right? And this one long trend. Okay, or inside this one long trend, there can also be multiple trends, right? Now, for example, here we know that there is a correction over here. Let me just draw, right? Okay, in April up to May, there was a correction here. Okay, and then of course in June until the mid of June, there's another correction. Okay, so what happens is this, right? So this is the first movement or the first wave, all right? And then the price goes into a sideways correction. Okay, once this is done, it goes into a second one and forms a second wave. And then this correction is over, so the second wave is done. This is the third wave, all right? And it's still basically there. It's now moving into a correction. Okay, so let's say this is the first wave, right? This whole thing here is the one wave. Okay, and then we have another wave that starts from down here to here. This is the second wave, and that's a third wave. Okay, I'm just gonna remove that or make it more transparent so you can see. Okay, so this of course this one is the current one, right? The third one. Okay, now so if I put a Fibonacci retracement tool, okay, on the first trend, that means this is the first trend from here. So again, I select from the bottom, which starts from here. This is the beginning of a trend, and then I have to click and hold the mouse button and bring it up to the top here, all right, where this is the top, right? This is the peak of that first trend, and just bring it forward. You can bring it forward as far as to the right hand side if you want. Okay, so what happened in this is, if you look at this this part here, I'm just going to zoom in the chart up to here. Okay, the price went to this high, it pulled back. Okay, we expect the price to pull back to a retracement level of 38.2%, which is here. 50% is here. 61.8% is here. Right, so we have basically 38.2. Let's say this is A. Okay, and then we have another one here, so that would be B. That's 50%. Okay, and another one would be at C, 61.8%. Okay, so question is which one, right? A, B, or C. So if you look at the price or this index, basically it came down, but it did not come down to A, it did not come down to B, it did not come down to C. None of them, right? The price just goes sideways. Okay, after pulling back here, not more than 38.2%. In fact, it just came down about 30%. Go sideways, and then the trend continue to go higher. All right. So this is a new trend, right? So I'm just going to leave this one here first, okay, the first Fibonacci, because I'm going to use this later in a short while, right? Then the price goes into an uptrend again, right? goes in an uptrend, 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 uptrend. Okay, then I can start drawing another Fibonacci retracement. Okay, and this time this is the second trend, the new trend that's developing. So it starts from here. Okay, and this is the possible ending at the top here. Okay, so we have basically A over here, 38.2. Okay, and then we have B. Okay, and then we have C. Okay, so question is which level, right? A, B, A, which is here 1005, B 1476, C 1550. So which one? Okay, so I go look back again. A, it does not provide me any support or resistance. B, also nothing much. C, there is some. Okay, but what I'm going to do now is I'm going to use remember the previous one here. Okay, because this whole thing can be considered as one trend, right? So the beginning of a trend could start from here. Okay, so I can actually extend this, put it to the current high as well. Okay, that's where the current high is. So now you have two Fibonacci levels. Okay, one that starts from here, the new trend. One starts from the beginning of this one whole trend. Okay, so right now, if you want to look at where the confluence of Fibonacci retracement levels, number one, it could be here. If you can see, right, this is where the price actually overlap. Okay, I know this can be a little bit complicated, but you know what? Just bear with me. Okay, just gonna make this thick as possible. Okay, so there's one here. There's one. This is a 38.2% retracement from the new trend, and it's also a 23.6. This is a minor retracement, right? 23.6 from this long-term uptrend. Okay, so that's one confluence. Now there's also another one here. So if you notice, there's one here. Okay, where we have the 61.8% retracement from the new trend, and also 38.2% retracement from the old trend. Okay, this is the old trend numbers lah. This is the new trend numbers. So there are two confluence. The others are okay. Of course, the other one will be down here, but this is at the bottom already lah, right? 100%. But so we are looking at here, these two. Okay, so question is which one should the price pull back to, or this index pullbacks to, before we get it to move into an uptrend again, right? So here I'm just gonna forward a little bit and see where the price actually pull back to, right? Or the index pull back to. Okay, I'm just gonna bring this forward. Oh, I can even bring the Fibonacci forward. Okay. Okay, so we're expecting the price to pull back to these two green lines, right? Number one is at 1005 because there's a confluence there. Number two at this level here at 1449 because there's a second level. But you guess what? Okay, it did not go to either of these two levels. Okay, it actually rebounded from the 50% retracement from the new trend, like you see here, exactly on the dot at 1476. Okay, it found support at 1476, which is a 50% Fibonacci retracement level from the current trend, and start to go higher. Okay, so that's why it's very difficult to identify which level is one. Okay, if I'm trading, I'll prefer to actually take action on those three levels. All right. So divide your position size into A, B, or C. So if I just use this, then I'll not be able to get the correct one. All right. But if I just use either A, B, or C, one of them will kena lah, right? It's like you put the trap there, eventually one will go into your trap. Okay. Or maybe two will go into the trap, or even all three will go into your trap. All right. So right now the price is going sideways. So if you look at the current trend, right? I'm just going to delete this. So you look at the current trend alone and apply Fibonacci retracement on the current trend. Okay. What you see here is that the price, after this trend, it pulls back, it actually rebounded at 38 point, exactly on 38.2% retracement. So imagine, like I say again, you buy at A, you put 33% of your position size at A, you are currently in, right? If you only buy at B, which is 50% here at 1546, then you are still not in. If you buy here, also you're not in at 61.8. Okay, imagine the price continues bullish trend. At least you still be able to ride on the trend. All right. Yeah, I'm just going to put in top left, reason being because that was the example. So it's the same chart here, right? Remember I told you that for the current trend, you can actually draw a Fibonacci retracement starting from here to here at the current price. Okay, I'm looking at this high over here lah. Okay, or you can also start to draw a Fibonacci retracement from the starting of this uptrend here to the current level. And same thing again, you look for confluence. So the main confluence level will be here, right? Because this is exactly where it is, which is a 50% retracement from the long-term trend that started in May, and a 61.8% retracement from the trend that starts in June. All right. So if you're going to expect a big correction for, let's say, discounted top glove, then you expect the price to come down to 15 to 16 ringgit. Okay, but these are unprecedented times for glove makers, right? So it's very strong movement, and in fact the price started to rebound after it pulled back the 38.2% retracement from the current new trend. All right, so if I draw this trend over here, remember it actually rebounded exactly at 38.2%, and it's now moving upwards. Okay, so if I want now, for example, for this particular trend, and let's say I still want to buy, and now the price is going high, right? It's actually a historical high. The question is, should I buy again, right? Now I forgot to show you one thing. I also want to show you trading volume, right? Okay, and you notice when the price goes up, the volume goes up very high, right? When the price goes up, like you see here, there's a congestion of volume which is very high. Okay, and here as well, when the price comes down, all right, if you look at this, like for example, when the price comes down, volume normally goes down, right? You compare this area here, the volume, compared to this volume over here, okay, this is much lower. You can see the average volume has come down as well. Okay, but as the price starts to go up again, you can see the volume has started to increase again. All right. So that's why I say when people continue to chase prices when they go up, okay, like here for example, I will not, if I, let's say, want to buy on dips, okay, when at what price should I buy? Okay, now because this is a very short-term time frame, again, on a daily chart, okay, if you want more details, because the good thing about Fibonacci drawing tool is it's pattern based, all right, it's not mathematical calculation. So you can see the pattern either in a short time frame or a long time frame. Okay, now for example, if I'm going to change it to an what do you call an hourly chart, an hourly chart looks like this, right? This is where we're supposed to plot, right? On that one candle where it rebounded from the 38.2%. Okay. Okay, I'm just going to go back to daily chart again. Okay. This is the current new trend, right? The current new trend, let's say, starts from here up to the current price here. That's the high. Okay, so yeah, so here you can see it's too congested. I can't really see it, but if you want to see, you can also see that, right? But if I want more details, I just go to the hourly chart, and then on the hourly chart, I get more details. Can you see this? Right, so I can see, I can plot it more precisely. Okay, at the bottom here, that's the start, and this is the possible ending. Okay, so I have three different levels. Okay, I wouldn't want to buy the high here. Okay, so I have three levels here. I have an option to buy at A, okay, which is 38.2% retracement, right? And I can also buy at B, okay, and I can also buy at C. All right, so now for the sake of analyzing, let's say you want to find a confluence, right? Or which one would probably be a better one, let's say, right? A, if you look at this line here, A, the green line, the top here, right? Was it a previous resistance or support level? Okay. In fact, you do find actually there's some support level. Okay, this is a support level here and near here 2 times, and also previously a support level here. So it's actually that line here at A at the 38.2% retracement level has a confluence of that uptrend line. Okay, B, it's going to bring up B. B is down here. B was a previous, okay, this one is not resistance level because the prices go up like this. B doesn't show anything, right? C, also not much because the price is just going up and down around that line. So A is the closest. Okay, so if I only want to select one, then I will select A. Okay, but if I want to trade, for example, this particular counter, then I'll wait for it to come down to A. I maybe buy 33% of my my position size at A, which is 23.80, and then B at 23, and then C at 22.20. Okay, so if let's say I buy at these three levels, and what happens, what, the price should rebound at least at 61.8%, which is C, right? Because in Elliott wave or in Fibonacci, the C or the 61.8% is always like your last line of defense, right? That means if the price goes down below 61.8%, you will not expect the price to trend higher anymore. All right, it's probably going to come down and go for a major or a bigger correction. Okay, so 61.8, like here in for this counter top, for example, 22.20 is the 61.8%. So if you want to identify a trend, as long as the price is able to stay above 22.20, that means this trend is still intact. All right, but if it goes below 22.20, that means this trend has weakened out. It's probably going to go into a bigger correction. Okay, so normally for traders, we will put a stop loss below C. So for example, 22.20 is the C, and the moment the price comes down to 20 ringgit, then I will exit, because that shows that the market or trend has already weakened. All right, so that's one of the ways of using Fibonacci. Okay, so any questions? Okay, so I already show you how to do Fibonacci, right? I mean, you can go back and try this. This is something that you have to practice. Okay. Faisal Zabidi, this is my wife. I mood swing up and down, up and down, up and down. So which kind of mood swing do you prefer? Do you prefer this kind of mood swing, or do you prefer the Nestle kind of mood swing, steady only? Okay. Really, right? It depends on your risk profile. I think the last webinar we talked about balancing your risk profile and your expectation on risks and and possible returns. Yep, CH Ang, you talk about another possibility is the theory of alternation. The theory of alternation is based on Elliott wave. So I'm not going to cover that because it's another big topic to cover. Okay, so yes, you can use the theory of alternation. You can you can use the other rules in Fibonacci in Elliott wave as well. Right? Um, but you know what? No matter what we do in analysis is based on experience. After you have gone through trading, you will find out that you need to develop a trading plan that's able to profit right consistently. That's the idea, because if it becomes subjective, then it's going to be very difficult to actually find opportunities in trading. Okay, so the thing is this, right? Everybody can learn about technical analysis, but it's how you apply technical analysis into your trading plan will make a big difference. All right. And technical analysis, like any other analysis, is just a tool. Okay. At the end of the day, the decision is yours. Okay. You have to come up with the next, you have to come up with your own trading plan that suits you. All right. Next stop, please. PG, which trend we should use Fibonacci? Well, I'm not going to cover that today because you know what, we are supposed to be educational in this webinar, right? You continue to join us, especially you can always come back to our sessions at 8 p.m., right? Especially on Mondays when we have a technical Monday, just join us there, all right? You can, for Fibonacci, you can use in an uptrend or a downtrend. I have a question from Baidu Zaman, right? So of course, for a downtrend, you are trying to find where is the resistance, how high should the price rebound before it go down some more. Okay, when we apply Fibonacci in an uptrend, is that we want to identify how the price should come down before it continues its uptrend. So that's the main difference. Okay, so you can apply Fibonacci either in a downtrend or uptrend. Okay, but your objective is to find the dip, the pullback in an uptrend, or the rebound in a downtrend. Okay, it's not extension. Maybe the next lesson could be on extension itself, right? Okay, so guys, I'm just gonna basically conclude this with I'm just going to show you my slides back again, because that's where you can actually download the slides, and I'm sure my colleagues over there will put a link on the comments section for you to fill up the fill up this evaluation or feedback form first. And once you have completed the evaluation form, which is actually just very few questions, short questions you have to answer, and then you will get an email to give with a link to download the slides. All right, so go to bit.ly/Bursa slides 200725, which is today's date, and then you should be able to get a form. Okay, or click on the comment link which we are going to put up, or probably has already been put up, right? Just click on the link, you should be able to go to evaluation form, right? So once again, please go to bursaacademy.bursamarketplace.com to learn more. This is provided by Bursa Malaysia himself. It's actually a new portal they've created to enhance your learning experience as an investor and a trader. All right, so with that, thank you very much for joining us. We'll see you again in the next webinar next week. Okay, also another investor education series brought to you by Bursa Malaysia. Same time, same day on Saturday. Thank you very much, and see you again.